Right now, 2.86 million landlords across the UK are leaving literal thousands of pounds on the table every single year in entirely legitimate tax savings because they are listening to the wrong advice. It's a tragedy of wasted opportunity, and it's especially shocking because if you're a basic rate taxpayer, you're holding a hidden, powerful advantage that almost no one is talking about. Since the 2020 crushing blow of Section 24 mortgage interest rules, the financial playing field for higher-rate landlords has become a minefield. But for you, the basic ratepayer, the maths work fundamentally differently. You hold the winning hand. Combine that secret edge with a vast landscape of deductible expenses that most overlook completely, and you have the power to substantially lift your bottom line and keep more of the wealth you've built. What follows is exactly how that system works, what you're entitled to claim, and the critical shifts that demand your immediate attention. But before we dive deeper into the hidden policy shifts that are already reshaping your finances and your property wealth, I need you to do one thing: gently tap that subscribe button right now. Don't miss this. UK Property Insights provides the clear, timely, and actionable summaries you need to stay one step ahead of the curve. You're here because you want the edge. Subscribing is how you guarantee you get it. Disclaimer: this is for informational purposes, summarizing our research. Please seek professional financial advice before acting on any strategy. Everything must be legitimate and above board. The single most destructive piece of legislation in recent landlord history is actually your biggest ally. Section 24 of the Finance Act 2015 is the reason higher-rate taxpayers have been frantically selling off properties. It's what you hear all the doom and gloom about in every property forum. And for 40% taxpayers, that pain is absolutely justified. But here is the massive secret: for basic rate taxpayers, everything changes. The mechanism is simple but brilliantly advantageous for you. Before Section 24, you deducted your mortgage interest directly from your rental income to calculate your taxable profit. That was the old way. The new way, which took full effect in April 2020, replaced that deduction with a 20% basic rate tax credit on your finance costs. Let's look at the numbers because this is the mind-blowing part. Imagine you have £15,000 in rental income and £5,000 in mortgage interest costs. The old system: £15,000 income, £5,000 interest equals £10,000 taxable profit. Taxed at 20%, you paid £2,000 in tax. The new system, Section 24, your taxable profit is the full £15,000. Taxed at 20%, that's £3,000. But you now claim a £1,000 credit, 20% of your £5,000 interest. £3,000 minus £1,000 still equals £2,000. The result is exactly the same. This perfect equivalence holds only because the credit percentage, 20%, precisely matches your income tax rate, 20%. A 40% taxpayer, however, only gets 20% relief against a 40% tax bill. That gap is where the financial pain hits, which is precisely why high-earning landlords have been fleeing the market. But you are shielded. This advantage, however, is delicate. It evaporates the moment your total combined income, everything from employment, self-employment, and all your rental income, crosses the current higher rate threshold of £50,270. That line is the boundary. Cross it, and any income above that point is taxed at 40%, and suddenly that 20% credit only covers half of what you owe on your mortgage interest. You must understand this threshold to survive. Globally, finance costs total over £9 billion in claimed deductions across the sector, so this isn't some niche rule. It drives how the vast majority of landlords operate. And this 20% credit covers not just the mortgage interest, but also loan interest for property purchases, interest for furnishings, overdraft interest, arrangement fees, and any incidental borrowing costs. But that wasn't the whole story. The credit only addresses one part of your expenses. There's an entire landscape of overlooked money. What most landlords completely overlook is that mortgage interest is only the opening move in a much bigger game. The vast majority of individual landlords are leaving substantial money on the table because they simply don't know what qualifies as a deductible expense to reduce their taxable profit. Start with the basics: the property running costs. These are the easy wins: water rates, council tax, when you are responsible for it between tenancies, any utilities that the landlord provides, buildings and contents insurance, any specific landlord liability policies, ground rent, and service charges on leasehold properties. All of it is straight off your income, pre-tax. You track these meticulously, don't you? Most landlords track them poorly. Next is the massive category of professional fees. This is where systematic underclaiming happens. Your letting agent fees. Deductible. Your accountant costs for preparing and filing your tax return. Deductible. Legal fees, if you're renewing a lease that's less than 50 years. Deductible. Surveyor fees. Deductible. Every professional service directly connected to the running of your rental business comes straight off your taxable profit. If you pay someone to help manage or maintain your business, the cost is likely deductible. This is critical: you're running a business, not a hobby. You must view and treat every single transaction through the lens of a business expense. Also, remember your marketing and administration costs. Advertising for tenants, business-related phone calls, stationery, the dedicated business proportion of your home broadband, all of this qualifies. HMRC's golden rule is the wholly and exclusively test: the cost must be entirely for the rental business, not for personal use. But if you're genuinely incurring these costs for your enterprise, you must be claiming them. Now, let's talk about the real missed opportunity. The one that will save you thousands. Travel expenses represent the single most overlooked and underclaimed category in the entire landlord expense landscape. This is where landlords are leaving thousands unclaimed annually. The rules are clear, yet the knowledge is somehow non-existent for millions of individual property owners. You can claim a fixed rate of 45 pence per mile for the first 10,000 business miles in a tax year, and then 25 pence thereafter. This is not a small number. At 45p a mile, that first 10,000 miles is potentially £4,500 in deductible expenses right there. So, what counts as business miles? Journeys from your home to any of your rental properties for inspections. Trips for necessary repair or maintenance visits. Travel to meet with tenants or prospective tenants. Journeys to meet with your letting agents, accountants, or solicitors for business purposes. Trips to DIY stores to buy materials for repairs. If you own multiple properties and visit them even quarterly, or you're an active, hands-on manager, you could easily clock up thousands of miles every year without even realizing it. Most landlords claim nothing because they assume travel is only deductible for limited companies or that the journey from home to property is a commute. It is not a commute, it is a business journey. You must keep a robust mileage log with dates, destinations, and business purposes. Things that absolutely don't qualify broadly fall under the category of capital improvements or personal expenses. The biggest one is the capital element of your mortgage payment. Only the interest qualifies, as we covered. Other non-qualifying costs include your own time or labor, initial furnishing costs before the first tenant moves in, and any fines or penalties received from authorities. Understanding the difference between what's deductible and what's not is where landlords collide with HMRC, and it all comes down to one simple question. This is perhaps the most contested and expensive distinction in property tax. Does their work restore an asset to its original condition, or does it enhance it beyond that? If it's a repair, it is deductible right now, against your rental income. If it is an improvement, it is capital expenditure, and not deductible until you sell the property, meaning you pay tax on that money today. Repair example: replacing a broken boiler with an identical or functionally equivalent new one. Improvement example: installing central heating in a property where none existed before. The line gets very grey, but here's the key piece of modern insight: we are not living in 1985 anymore. When you replace single-glazed windows that are beyond repair, you will replace them with modern, contemporary double glazing. Is this an improvement? Technically, yes. But HMRC accepts that this is the modern equivalent or like-for-like replacement using current standards. It is necessary to meet modern letting standards and restore the asset. Therefore, the entire cost remains deductible as a repair. The same logic applies to replacing old lead pipes with copper or plastic. You are using the modern equivalent to restore function. HMRC accepts this. Claim the whole thing. The incidental improvement loophole. Things get even more interesting when improvement is incidental to a necessary repair. Imagine a storm damages your roof, and the contractor says, "While we're here, we could upgrade the insulation in the loft to meet current standards." You approve the insulation work. Since the primary driver was the necessary repair, the storm damage, the entire cost, including the incidental improvement, the insulation upgrade, can be argued to remain deductible as a repair. Where landlords fail is in the area of pre-letting expenses. You buy a tired property, and before the first tenant moves in, you spend money on decoration, carpeting, and refurbishment to bring it up to standard. This is almost always considered capital expenditure because you are preparing the property for its first use in your rental business. It does not count as a repair because there was no existing state to restore. However, there is a 7-year look-back window. Expenses incurred up to 7 years before the property was first let can sometimes qualify. Advertising costs, agent fees, and actual repairs to bring a property into a lettable condition might qualify under this provision. The best way to think about it is this: restoration is a repair. Creating something new or substantially better is capital. And while we are talking about repairs, we have to discuss the relief that is sitting there for almost every landlord, and yet is almost completely unused. There is a specific tax law, available since April 2016, called the Replacement of Domestic Items Relief, and most people miss it entirely. This is a direct, straightforward deduction that applies to furnished, part-furnished, and even unfurnished properties. This is money you are entitled to claim and should be claiming every time you replace an item. What qualifies? It applies to movable assets within the property. Movable furniture, beds, sofas, tables, wardrobes. Furnishings, curtains, carpets, linens. Household appliances, fridges, washing machines, cookers, televisions. Kitchenware. The operative word is replacement. You absolutely cannot claim the initial purchase cost when you first furnish a property. But when that sofa finally wears out after 3 years of tenant use, and you buy a new one, that replacement cost is claimed. For simple conditions must be met. 1. Your business includes letting a dwelling. 2. The claim covers a replacement, not the initial purchase. 3. The new item is for the exclusive tenant use. 4. The old item is no longer available to the tenant. How to calculate the claim? It's straightforward. You take the cost of the new replacement item, or the cost of the nearest modern equivalent if you are upgrading, and then subtract any proceeds from selling or trading in the old item. Example: you trade in an old fridge for £100 towards an £800 replacement. You claim the net cost, £700. The upgrade trap: if you upgrade from a standard £400 sofa to a £550 sofa bed, you can only claim the cost of the equivalent replacement, so you would claim £400, not the full £550. One critical caveat: fitted items, things like baths, toilets, boilers, integrated kitchen appliances, or built-in wardrobes, fall under the repair rules we just discussed, not this relief. But the movable items, which constitute the vast majority of contents in a furnished property, qualify directly. This is a simple, massive deduction that you must start using today. Now that we've covered the biggest deductions, let's talk about the strategies that can keep you in the basic rate sweet spot and the government changes that are already biting. While maximizing deductions is key, employing basic tax planning strategies can ensure you remain in that Section 24 sweet spot and avoid being dragged into the higher tax bands. One simple, often overlooked option is the £1,000 property allowance, available since April 2017. If your gross rental income is £1,000 or less, you don't even need to file a tax return. If you exceed £1,000, you have a choice: claim your actual, documented expenses or take a flat £1,000 deduction. For most active landlords, actual expenses exceed £1,000, so you claim those. But this option eliminates meticulous record keeping if your expenses are low, and it's a quick win. A more advanced, powerful strategy is spousal income splitting using HMRC's Form 17, if you're married or in a civil partnership. By default, jointly owned properties are taxed 50/50ths, regardless of the actual beneficial ownership. If one spouse earns significantly more and is nearing or is in the higher rate bracket, you can legally file Form 17 and get taxed according to the actual beneficial ownership instead. You would need a deed of trust to legally document an unequal ownership split, perhaps 80/20ths or 90/10ths in favor of the lower earning spouse. This means 80% or 90% of the rental income gets taxed at the 20% basic rate, effectively keeping you shielded from the Section 24 penalty. This requires legal documentation but is a game changer for couples. Another, smaller win is the marriage allowance. If one spouse earns less than the £12,570 personal allowance, they can transfer up to £1,260 of their unused allowance to the other, saving up to £252 annually. The fiscal drag trap. Now for the bad news. Recent budgets have frozen income tax thresholds until April 2031. Your personal allowance stays at £12,570. The basic rate limit stays at £50,270. This is called fiscal drag. As inflation pushes your income up, more and more of your money is being pushed into the 40% tax band because the thresholds aren't moving. The government estimates this will pull over 700,000 additional people into paying income tax by 2031. The £50,270 line is not a static safe zone, it's a moving target that is getting closer to you every single day. Beyond income tax, two massive legislative shifts are about to change how you operate, and they are not far off. The next few years bring a legislative tsunami that will reshape the landlord landscape, requiring proactive preparation and investment. These are not distant possibilities, they are deadlines that are months away. First, the Renters' Rights Act 2025 becomes fully active from May 1, 2026. This is a massive change. The infamous Section 21 no-fault evictions disappear entirely. Every eviction will now require Section 8 grounds, meaning you must have a legally specified reason. The assured short-hold tenancies convert by default to rolling periodic tenancies, giving tenants much greater security. Tenants gain an explicit right to keep pets unless you can establish a reasonable ground for refusal. Furthermore, advanced rent payment will be capped at just 1 month, and a mandatory private rented sector database and ombudsman will launch in late 2026. Your operational risks and management complexity are about to increase dramatically. Second, the expansion of making tax digital, MTD, for income tax is mandatory and unavoidable. From April 2026, any landlord with property income exceeding £50,000 must file digitally using quarterly submissions through HMRC-approved software. This means no more annual paper-based filing for many. From April 2027, that threshold drops sharply to £30,000. This is not optional. It is a mandatory requirement that fundamentally changes your filing process from an annual task to a quarterly digital submission. You need to select and learn MTD-approved software now. Finally, there's the EPC, Energy Performance Certificate, consultation looming. The current baseline minimum is Band E. Government proposals suggest a Band C minimum by 2028 for new tenancies and 2030 for all tenancies. Government data suggests that the average upgrade cost to hit Band C is approximately £6,864 per property. If you own multiple properties below this standard, the capital expenditure needed in the next 3 to 5 years could be enormous. You need to budget and plan for these upgrades now. The combination of the Section 24 pinch on higher earners, the removal of Section 21, and the mandatory shift to digital tax filing is creating a perfect storm. The 2.86 million landlords operating today will not all remain in 5 years. Survival requires efficiency. You came looking for a blueprint to reduce costs as a basic rate taxpayer, and here sits your framework for not just reducing costs, but for surviving the next wave of legislation. First, understand your actual advantage. You are holding a better position than higher rate landlords on Section 24, but that 20% credit lifeline only holds if you stay below the £50,270 total income threshold. Cross that line, and your advantage is gone. Second, claim every single deduction you are entitled to. Most landlords are not claiming their travel expenses. Most are not maximizing professional fees. Most are not using the replacement of domestic items relief systematically. These aren't exotic loopholes, they are standard, expected deductions. Get meticulous with your record keeping today. Third, distinguish properly between repairs and improvements. Remember the modern materials rule and the incidental improvement gray area. Get this distinction right, and you will save thousands on tax owed this year. Fourth, evaluate your tax structure. Can spousal income splitting keep you and your rental income in the basic rate zone? It's a powerful move worth exploring with an accountant. Finally, prepare actively for the future. The Renters' Rights Act and making tax digital are not distant possibilities. They are deadlines that demand action now. Your ability to control costs, maximize deductions, and operate efficiently is what will determine whether you remain competitive or exit like so many others are doing. Control your costs, maximize your efficiency, and understand your tax position. That is how you stay in the game. If you found this breakdown helpful, don't forget to hit that like button and subscribe to UK Property Insights for more essential updates on the UK property market. We cover everything from legislation changes and market trends to practical advice for tenants, landlords, and investors. Ring the notification bell so you never miss an update that could affect your property decisions. Thanks for watching, and we'll see you in the next one where we reveal the single biggest mistake landlords make when setting their rental price.